Back in October, Bitcoin hit an all-time high, $126,000. 5 months later, as I'm recording this, it's at 65,000. That's nearly a 50% drop in 5 months, and people are freaking out. Is it crashing? Should I sell? Should I buy more? What is happening? Why is Bitcoin so volatile? Stock prices don't move like this. Your savings account definitely doesn't move like this. So what's going on? And more importantly, how do you handle it without losing your mind? Welcome back to Decoded with Laura. Today, we're talking about Bitcoin's volatility, why it happens, what drives it, and how to stay sane when the price is swinging all over the place. Let's break it down. So, why is Bitcoin so volatile? First, it's a smaller market. The market cap, that's the total value of all the Bitcoin in existence, is way smaller than traditional assets. To put it in perspective, Bitcoin's market cap is around 2 trillion. The entire US stock market, well, that's over 50 trillion. Gold, about 15 trillion. Smaller markets mean it's easier to move the price. Less money is needed to push it up or down. Second, Bitcoin has 24/7 trading. The stock market closes at 4 p.m. Eastern and doesn't open again until 9:30 a.m. the next day. Weekends off, holidays off. Bitcoin never closes, ever. Trading 24 hours a day, 7 days a week, 365 days a year. Something is always happening somewhere in the world. Third, it's a global market. Bitcoin doesn't care about borders. It is traded everywhere all at once. Conflict in Iran? That affects oil prices, which affects global markets, which affects Bitcoin. US announces new regulations, price moves. China cracks down on mining, price moves. A country adopts Bitcoin as legal tender, price moves. World events hit Bitcoin immediately because it's traded globally 24/7 with no breaks. You go to sleep, wake up, and the price moved 15% because something happened in Asia or the Middle East while you were sleeping. That's just the reality of global, always-on markets. Fourth, it's still relatively young. Bitcoin is 15 years old. Gold has been around for thousands of years, stock markets for centuries. Bitcoin is still finding its place, still maturing, and that creates volatility. Fifth, no circuit breakers. Stock markets have what are called circuit breakers, automatic trading halts when things get too crazy. If the S&P 500 drops 7% in a day, trading stops for 15 minutes to let everyone calm down. Bitcoin doesn't have that. If it wants to drop 20% in an hour, it can. If it wants to pump 30% overnight, it will. Nobody is stopping it. Sixth is leverage. Leverage amplifies everything. Leverage means trading with borrowed money. You put $1,000 in, but you're controlling $10,000 worth of Bitcoin. When the price moves in your favor, you make way more money. When it moves against you, you lose everything fast. And when lots of leveraged traders get liquidated, meaning they're forced to sell because they ran out of money, it creates cascades. Forced selling triggers more selling, which triggers more selling. That amplifies moves in both directions. All of this adds up to Bitcoin is volatile. That's just what it is. But here's the thing that makes it even more volatile: human psychology. Fear and greed drive everything. FOMO, the fear of missing out, it's going up. Everybody's making money. I need to buy now before it's too late. So you buy at the top because you're scared you're going to miss out. Then the price drops and you panic. It's crashing. I need to get out now before I lose everything. So you sell at the bottom. Buy high, sell low, the opposite of what you're supposed to do. But that's what emotion does. And it's not just you, it's everyone. Herd mentality. If everyone's buying, you feel like you should buy. If everyone's selling, you feel like you should sell. You're trading against people who are terrified or euphoric, not rational, emotional. And that creates wild swings. When everyone's greedy, the price shoots up beyond what makes sense. When everyone's scared, the price crashes harder than it should. This is human nature. This is how markets work, especially volatile ones like Bitcoin. Now let's talk about who is actually trading Bitcoin because that has changed a lot. In the early days, the 2010s through, let's say, 2021, Bitcoin was mostly retail. Retail means regular people, you, me, individuals buying Bitcoin on Coinbase or Kraken. That created a certain kind of volatility, emotional, reactive, FOMO driven. When the price pumped, retail would pile in. When it crashed, retail would panic sell. That's what made 2017 so wild. That's what made 2021 crazy. But something shifted. 2022 happened. Terra Luna collapsed, people lost everything. Then FTX blew up. More people lost everything. Retail got burned hard, and a lot of them left. They sold, they gave up, they said, never again. And you can see it in the data. Retail participation is way down compared to 2021. Meanwhile, institutions showed up, and I mean big institutions. MicroStrategy, now called Strategy, started stacking Bitcoin back in 2020. And they were early for a corporation, way before it was cool to do this. Now they hold over 700,000 Bitcoin, more than most countries. BlackRock, Fidelity, major corporations adding Bitcoin to their balance sheets. January 2024, Bitcoin ETFs got approved. That changed everything. Now, institutions can buy Bitcoin through traditional channels. No need to set up crypto accounts, no need to deal with self custody. Just buy the ETF like you'd buy a stock. And they did. Billions of dollars flowed in. By the way, if you want me to do a deep dive on strategy and what they're doing, let me know in the comments. That's a whole video on its own. So now the market is dominated by institutional money, not retail. And institutions trade differently than retail. Retail is emotional. See price go up, buy. See price drop, panic sell. Institutions are strategic. They have longer time horizons. They have professional traders and algorithms. They're not checking the price every 5 minutes and freaking out. They're looking at Bitcoin as a percentage of their portfolio, as a hedge against inflation, as a long-term store of value. They're not selling because the price dropped 10% today. So what does that mean for volatility? Different patterns. You don't get the same retail-driven panic anymore. Less emotional swings. But you also don't get the same retail-driven enthusiasm. Less explosive pumps fueled by FOMO. The market is maturing. It's becoming more professional. Now, does that mean there's no manipulation? No. Whales still exist. Big players can still move markets. One institution selling 100 million worth of Bitcoin, that'll move the price. And they know it. They know where retail used to have their stop losses. They know where the leverage is concentrated. They can trigger liquidations. Pump and dump schemes still happen, though less than before. Fake news and FUD, fear, uncertainty, doubt, still spreads. Someone tweets something, the price is going to react. And I'm not saying every move is manipulation. Most of it is just normal market dynamics. But big money knows how to play the game. And here's the thing. They profit when you panic. When retail freaks out and sells at a loss, institutions buy the dip. When retail FOMO buys at the top, institutions sell into that demand. That's not conspiracy theory. That's how markets work. So why isn't retail showing up like they used to? A few reasons. They got burned in 2022, lost trust, scared to come back. The narrative's also changed. It's not get rich quick anymore. It's institutional adoption and store of value, which is less exciting to retail. The barrier to entry also feels higher now. It's not the Wild West anymore. It's more BlackRock and Fidelity. It feels less accessible, even though it's technically easier. And honestly, a lot of retail is waiting for the bottom, waiting for confirmation, waiting for it to feel safe. But by the time it feels safe, the big moves have already happened. That's always been true, and that's still true now. So, with all of this volatility, how do you make sense of it? Everybody has a prediction. Bitcoin to 1 million by next year. Bitcoin to 0, it's all a scam. We're in a bull market. No, it's a bear trap. Who do you listen to? Technical analysis, that's reading the charts, looking at patterns, using indicators to try to predict where the price is going. I watch Ivan on Tech for technical analysis. He breaks down the charts, explains what he's seeing, walks through different scenarios. It's interesting and it gives you perspective on what's happening and why. But here's the thing, it's not a crystal ball. Technical analysis can show you trends, support levels, resistance levels. It can give you probabilities, but nobody knows what's going to happen. Nobody. Then there's news and sentiment, what's actually happening in the space. I like to watch The Modern Investor for news and what's going on. He covers developments, regulations, big moves in the market. It keeps you informed without being sensational or panic inducing. So, how do you consume all of this information without losing your mind? Here is my approach. Watch for information, not predictions. Understand the why behind the moves. What's causing this? What's the context? And don't make decisions based on one person's prediction. Everyone's guessing. Some are more educated guesses than others, but they're all still guesses. Learn how to read the market yourself. Understand the basics. Then decide what makes sense to you. Because at the end of the day, it's your money, your decision, your responsibility. So, how do you handle Bitcoin's volatility? Here's the truth, it's important to know what's going on, stay informed, watch the crypto news, understand the trends, but you don't have to stress out about it. Long term perspective beats short term panic. If you're in Bitcoin for the long haul, years, not weeks, then a 20% drop this month doesn't matter if you believe in where it's going. Zoom out, look at the big picture. Don't check the price every 5 minutes. Seriously, don't. I know it's tempting. I have been there. You refresh, you check, you refresh again. It doesn't help. It just stresses you out. Set a schedule. Check once a day, once a week, whatever works for you. But the constant checking, that's how you make emotional decisions. Have a plan. Have a buying strategy. Are you dollar cost averaging, buying dips? What is your entry strategy? Your selling strategy, if you even have one. Are you holding long term? Do you have a price target? What is your exit plan? Whatever your plan is, write it down and stick to it. Don't change your plan because the price moved 10% today. And know yourself. Volatility is the price of admission for Bitcoin. If you can't handle 30% swings without panicking, this might not be the right thing for you. And that's okay. Not every investment is for every person. Some people can handle the volatility, some can't. Just know yourself. Be honest about what you can handle. Because if you're stressed out every day watching the price, that's information. That's telling you something. So here's the bottom line, Bitcoin is volatile, and that's not going to change anytime soon. Small market, global trading, 24/7 access, human psychology, institutional versus retail dynamics, big money playing games. All of that creates wild price swings. But volatility isn't a bug, it's a feature. This is what comes with an asset that governments can't control, that trades freely around the world, that operates outside the traditional system. You want freedom? This is what it looks like. Stay informed, don't stress, stick to your plan. And remember, if you're in it for the long term, today's price doesn't matter as much as you think. Thanks for watching. I'll see you in the next one.